And joining us now with his analysis of the Dow's record run is Peter Cardillo, the chief market economist of Rockwell Global Capital. Peter, thanks for joining us today.
Good to be back.
Peter, the Dow hit another record high. That's 3 days in a row. We've had central banks around the world injecting monetary stimulus, keeping record rates at a record low, including the ECB and the Bank of England today, as Phil just mentioned. Is this rally fueled mostly by central banks and in the U.S. by the Fed?
Indeed, indeed. We can thank Bernanke and we can thank the global central banks for this. You know, cheap money is a powerful ingredient for the stock market, and that's why we have such a good market environment at this time.
So what happens when Bernanke pulls the plug? Just about a week ago, the Fed minutes from January were released, and it was interpreted that the Fed may or may not continue the stimulus program. What happens when he actually does go ahead and pull the plug?
Well, I don't think he's going to pull the plug anytime soon because, you know, if you look at the economy, we're growing at a very modest rate here. And basically, even the job market, even though there's improvement, you know, we're still basically staying within a very slow, modest growth environment in creating new jobs. In fact, I think the market might be a little bit disappointed tomorrow because I'm calling for a jump of about 145,000 non-farms with total unemployment around 7.9%.
So you don't think the jobs numbers is going to be as strong as people are expecting it to be?
I don't think it's going to be close to 200,000, no. But again, it's consistent, so it's not going to be a negative number where it's going to really have a major negative impact on the market. Absolutely not.
Now, you bring up the unemployment number, and many argue that this is a fake recovery when you look at the fundamentals of the economy. When the Dow hit its old initial record in October of 2007, we had a different picture. Unemployment was 4.7. Now, January, it was 7.9. In the third quarter of 2007, GDP was at 3%. The fourth quarter of 2012, GDP was 0.1%, so forth and so on. So these fundamentals aren't matching up with the markets. What is going on?
Absolutely. There's one big difference, that interest rates were not at 0 or 0.75%. So that's the difference. I mean, interest rates were close to maybe 4.5%. And there we go again, you know, that powerful ingredient, cheap money.
But is this showing a real disconnect between Wall Street and Main Street?
Well, there's no question that there's a disconnect, but you also have to realize that companies have adjusted, and that is in terms of earnings growth, even in a very sluggish and modest economic environment. So, you know, we're really not seeing just yet where the PEs have gotten to levels that would threaten the market's rally, or obviously suggest that we're in some sort of a speculative bubble. That's not the case at all.
Now, you're saying that companies have adjusted, and that's absolutely true. They've cut costs. They've really reined in all the access. So with them trimming all this fat, where is it left to go? Are we going to see companies not meeting earnings expectations?
Well, I think that's one of the reasons why we're not seeing a real jump in the jobs market, because companies are not putting on extra help. They're staying mean and lean, and at the same time, they're producing earnings growth.
But we're seeing a jump in the markets, and you also think that this rally is going to continue. You've got some high projections for the end of the quarter. Tell me about that.
That's correct. I think by the end of this quarter, we'll probably see the S&P close to 1575, 1585, when it's that far away. And we'll probably see the Dow tack on perhaps maybe another 200 points. So we could be looking at 14.5, 560, around that level, before we go into a trading range, and then possibly a sell-off in the latter part of April and May.
So what do you think could really derail this rally?
What could derail this rally? If the lawmakers do not reverse the automatic cuts that have gone into effect, that could mean we could be facing higher levels of unemployment. and that could mean that we could see growth actually be flat or possibly have a quarter or two of negative growth. That obviously would take the starch out of the stock market because that would affect earnings.
And we're still waiting to see what Washington does about that sequester. So far, the market has ignored it. Peter Cardillo, thank you so much for joining us. That's Peter Cardillo, Chief Market Economist of Rockwell Global Capital.